With having said that, we are really ready to proceed. So what is divergence? We talked about it, you remember. If you're not sure what divergence is, then I refer you to visit and listen to FXStreet webinar I did last month. You will see what divergence is. I think that webinar is uploaded, and that is the basics of divergence. Now we need to delve a little bit deeper into divergence to see how we can use with stochastics. Different types of divergence, stochastic divergence, MA divergence, and examples, okay? So pay special attention to this today, because this information can be really, really good and useful when you trade. Now let's just do a quick reminder about divergence. So when we talk about divergence, we know that divergence in that trading sense is definitely the earliest indication of reversal, okay? Is the earliest indication of reversal. We already know that because when we trade, we should not guess, right? Because guessing will definitely give a habit to trade with a gut feeling. So we don't want to trade with any gut feeling, and there is no guessing in Forex market. Some time ago, it's a week ago, I also started to write few things about trading and interesting things about trading on gambling forums. And definitely I use this opportunity to basically say that you should always differentiate trading and gambling, no matter what others think and no matter what others say. If you trade Forex market as gambling, then you're a gambler basically, you're not a trader. But if you add the odds to your favor, when you're stacking the odds to your favor, then that makes you a trader. It doesn't matter if you're winning or losing trader. As soon as you start adding odds to your favor, you're the first step closer to being right trader. So the thing is, when we want to trade, especially counter trend, okay, then we definitely need to use the confirmation for that counter trend trade. Being said that, and having said that, divergence for me, in my opinion, is the earliest indication of reversal. And when I spot divergence close to important support and resistance level, that can be usually a very successful trade with good risk to reward and with small risk, because stop loss is definitely smaller than if we use trend trades. So it's a good sign also to exit a position. So let's say if you are long and you see a bearish divergence, that is definitely a good sign to exit your position if you see bullish reversal. If you are, let's say, short and you see a hidden bearish divergence, that is a good sign to scale into a position. Okay? So it means that you usually buy near the bottom or selling near the top. So we know about it already. Okay? And we know which are different types of divergence we use in trading. So regular bullish, hidden bullish, regular bearish, and hidden bearish. We all know that from previous webinar. Okay? Also, we know that hidden we use for trend trades. Okay? Hidden divergence is only used for trend trades. For scaling into a position or entering a new position, we use regular for counter trend trades and reverse divergence for counter trades. Okay? So today it's a little bit different because we have all of this which I mentioned, but we had basically multiplied it. We will have type A, type B, type C. Okay, type A, type B, and type C divergence. Pay attention. So, first of all, stochastic divergence. Stochastic is a leading indicator. Okay, it is following the price action, and each single indicator which is following the price, following the steps of the price, it's called a leading indicator. The difference between leading and lagging indicators is lagging indicators are momentum and trend capturing indicators, and leading indicators are usually found in trend trading systems, and we use trend or leading indicators to effectively enter a position. Okay, so stochastics is pretty much widely used for entering a new position once the trend is established. Okay, mostly traders use stochastic divergence for entries, but they also use stochastic for overbought and oversold conditions, not just entries and divergence. So basically, stochastic indicator is used for entries, overbought, oversold conditions, and divergence. Okay, that's the typical use of stochastic indicator. I need to say that by default, stochastic has 80 and 20 levels plotted on the indicator itself, and those 80 and 20 levels are two main levels, which stochastic is distinguished from other indicators which also use overbought and oversold conditions. Now, as all indicators, and let's say most of the indicators, we can experiment with it. So we can use stochastic on different settings. The settings which I recommend and most common settings are 533, 833, 835, 1433, 1455, 855. Okay, 835 is pretty good in spotting divergence, so 835, but also it's good 833, 855. You can experiment with it. As I say, 835 is pretty much close to being the best of all of these settings. So we have also used, and we have been using divergence for giving us overbought and oversold signals. Overbought and oversold signals are used when we trade counter trend and when we basically want to enter a lower time frame by aligning the momentum. That's another story. We will talk about it when I present you multiple time frame trading and momentum. But now concentrate on overbought and oversold. So when we see that stochastic is effectively above 80, we say that that particular market or the price pair is overbought. When stochastic is below 20, we say that that particular pair market is oversold. So that is how stochastic is used, and mostly when you use stochastic for overbought and oversold conditions, you use it for spotting possible counter trend opportunity or trend opportunity on lower time frame. If the higher time frame has a long trend, bullish trend, then next lower time frame has also bullish trend, but our entry time frame is having oversold signal that can be a good spot to enter when the price has already dropped down a bit. And of course we use it with other indicators, but stochastic, no matter what other people say, is really a good indicator. It can tell you a lot. Not just entries, not just overbought, oversold. It can tell you a lot about possible reversal of that particular market. Okay? So, we have three types of stochastic divergence classification. Three types. Type A, Type B, and Type C. Okay? So that is how we classify stochastic. In this particular slide it says I will use mix of MACD and stochastic example, but I have prepared just stochastic example because MACD can confuse you. So we will use just stochastic